Stagflation explained what it is and how it affects your wallet. Inflation has been the economic villain of the past few years, but there's a new term creeping back into the spotlight: stagflation. It sounds like something out of an old economics textbook, but it's suddenly showing up in headlines, expert interviews, and financial forecasts. So, what's going on? Stagflation is basically the economic equivalent of being stuck in traffic while gas prices spike and your car starts making a weird noise. It's when the economy slows down, prices keep rising, and jobs become harder to find all at the same time. Recently, Federal Reserve Chair Jerome Powell tried to calm everyone down by saying the US isn't in stagflation. He reminded people that the term comes from the 1970s, when inflation was out of control and unemployment was painfully high. But despite his reassurance, some economists aren't convinced. They point to stubborn inflation, softer job numbers, and rising energy prices, especially with the conflict in Iran pushing oil costs higher, as signs that we might be inching closer to stagflation territory. So let's break down what stagflation actually is, what causes it, and how it affects your everyday life. What stagflation really means. Stagflation is a mashup of stagnation and inflation, and it describes a situation where three things happen at once. It occurs when the economy slows down or shrinks, prices keep rising, and unemployment increases. It's a rare combination because normally, inflation happens when the economy is growing. But stagflation flips that script. Everything gets more expensive while the economy weakens. The last major episode in the US happened in the 1970s, when OPEC dramatically raised oil prices. That shock rippled through the entire economy, pushing inflation higher and slowing growth. It became a decade-long headache for policymakers and households alike. What causes stagflation? There's no single trigger. Stagflation usually shows up when several economic problems collide at once. Here are the big ones. First, supply chain disruptions. When essential goods become scarce, think oil, food, or key manufacturing materials, prices jump. At the same time, businesses struggle to produce and sell as much, which slows economic growth. Second, consumers pull back. When everything costs more, people naturally spend less. That drop in spending hits businesses hard, leading to hiring freezes, reduced hours, or layoffs. Third, wage price spirals. Workers ask for higher pay to keep up with rising prices. Companies raise prices to cover those higher wages. And the cycle keeps feeding itself. Fourth, government policies. Sometimes tax changes, regulations, or spending decisions unintentionally slow the economy or raise costs for businesses and consumers. Fifth, the Federal Reserve missteps. The Fed tries to keep the economy stable, but if it overstimulates growth or reacts too slowly to inflation, it can accidentally create the conditions for stagflation. Usually it's not one of these factors, it's several happening at once, creating a perfect storm. How stagflation shows up in your everyday life. Even though stagflation sounds like something only economists debate on TV, you'd feel its effects pretty quickly. First, prices keep rising. Groceries, gas, rent, utilities, everything gets more expensive. Your paycheck doesn't stretch as far, and you may find yourself relying more on credit just to cover basics. Second, jobs become less stable. Businesses facing higher costs and lower sales may cut staff, reduce hours, or slow hiring. That can mean fewer opportunities, lower wages, or layoffs. Third, saving gets harder. When you're paying more for essentials and worrying about job security, saving money becomes a challenge, especially if you're juggling high-interest debt. Fourth, long-term plans get delayed. Buying a home, starting a business, or even taking a vacation can feel out of reach when both prices and economic uncertainty are rising. How to protect yourself, even if stagflation isn't official. Whether or not the US is technically in stagflation, preparing for economic uncertainty is always a smart move. A few steps can help strengthen your financial cushion. First, pay down high-interest debt. Credit card debt becomes especially painful when prices rise and income feels shaky. Second, build an emergency fund. Even a small buffer helps. Parking it in a high-yield savings account gives you a little extra growth without risk. Third, diversify your income. A side gig, freelance work, or skill building that boosts your earning potential can give you more stability if the job market tightens. And fourth, be strategic with big purchases. If you don't need to take on new debt or make a major financial commitment, waiting can give you more flexibility. The final thoughts. Stagflation is back in the conversation because the economy is flashing a mix of warning signs: stubborn inflation, slower growth, and shake your job data that echo the conditions of the 1970s. While the Fed insists we're not there yet, some economists see enough red flags to stay cautious. For everyday people, stagflation would mean higher prices, less job security, and a tougher time saving. The best move right now is to shore up your finances, pay down high-interest debt, build an emergency cushion, and avoid big financial commitments until the economic picture becomes clearer. Please comment below on your thoughts. I'd love to hear your perspective.